All right, guys, welcome to section 4, the last section. Finally, you're almost there. You almost have all the information you need. We're just going to go over some very important parts here. Risk management, first of all, and we'll follow it up with compounding profits, and then we've got something to show you after that. All right, so let's go ahead and get started in section 4. All right, so here we're going to go over how to pick a trade based on your portfolio size, based on your risk tolerance. So in our Discord, we send out multiple signals per day, okay? We send between something like 5 and 20 each day. And in order to manage your risk properly, you shouldn't really put all of your money or all of your buying power into a single trade, especially because there's multiple. So you have multiple opportunities to get in. You can get in a bunch of them, in all of them if you really want to. But it's probably best not to put all the eggs in one basket. You can tell which trades are out of your budget by checking the premium right away. So right here, as an example, every play we put out will have a premium listed at the end of it. A $28 premium is a $2,800 contract. Okay, so let's say if your account is $3,000, you probably should not buy this contract since it's going to occupy 93% of your capital. It's going to tie that up. All right, so it's probably not a good idea at any point to have 93% of your portfolio on a single play, let alone a single contract. All right, so after that, you're going to be left with $200 to enter any other position, which isn't really much. You're really riding a lot on this one, and it's not a good idea. All right, so definitely make sure you always leave buying power to buy more contracts if necessary. Sometimes we need to average down or buy a contract twice at two different prices at a lower price. That way you can get into the profit quicker. And even when you are in multiple positions, you should definitely always still leave buying power in order to go ahead and rebuy or average down whenever necessary. But overall, you should be able to look at a play like this one, okay, and say, this one's out of my budget, okay, or this one is too risky for me, because the risk score in this specific play is 7. So it's, it's not that risky in terms of taking it on. It does say long swing play, so you also don't have to trade this one. And you can see the expiration is in April, so it's very far away. You're not at risk of losing anything serious right away. The only thing that you would judge in this case is whether the premium would make sense for you to pay or not. So again, if you have a $3,000 portfolio, it's not the contract for you. If you have a $5,000 portfolio, it's not the contract for you. And if you do want to take on this contract, make sure it's not tying up too much of your money. All right. We're going to move on now to compounding profits and what it means and how to make more money every single time on our trades. So compounding is the process in which an asset's earnings from either the capital gains or the interests are reinvested to generate additional earnings. For example, if I start a company with $100 and I make $150, I now have $150 total, 50 of which are profit. But next time I'm going to go in and put in all 150 and I'll make 200. That way I'm using my new money to make even more money, if that makes sense. That's the essence of compounding. All right. Therefore, it differs from just straight growth. Okay. Let's say I go in on a play on, let's say, every play, and I put $500 into every single play every time. It'll grow over time, but it won't grow like you put 500 and then in the second play you put what you made from the first play, now 600, and then you put in what you made from the second play into the third play, now 800. So compounding can definitely lead to a lot faster and a lot larger growth. All right, so just to paint a picture, suppose $10,000 is held in an account, and that account pays 5% interest annually. All right, so after the first year of compounding period, the total in the account will be $10,500 because 5% of $10,000 is $500. So the $500 is the immediate reflection in principal. Now in year 2, let's say the account grows another 5% from the interest rate, and now you're going to see a balance of $11,025. Now, the reason you made more the second year is because you used the profits that you made the first year on top of your already invested capital. So after 10 years, if you don't withdraw anything and you just make 5% every single year, the interest alone would grow your account to $16,288.95, and that's just on 5%. Obviously, we aim to go much higher with our plays, and we aim to do it on a daily basis. So compounding, with this example, obviously showed you the power over time, but compounding with our plays can really make for some serious gains. All right, now we're going to go ahead and get into detail about how to manage your risk effectively and how to size your positions when you want to get in on a play. We're going to go through a brief example here, and we're going to show you why smart and good risk management is very important when it comes to trading, okay, especially options. All right, so we're going to go ahead and jump right to the example. Let's say that you are using a service, whether it's a technique that you developed yourself or you're in a group, or you're getting your plays from an advisor, whatever the case may be. Let's say whoever it is in the technique has a 50% win rate. All right, so we'll use that as the standard, and that the technique has a 1 to 2 risk reward ratio on average. All right, which basically means that for every dollar you invest, you get 2 back if you're correct. All right, so if your play loses, you lose $1. If your play wins, you would win $2. That's if the investment was $1. All right, so we're going to go ahead and jump into the example where we're going to give you traders Alan and trader Greg. All right, so Alan is a heavy trader. All right, he just starting investing, and he has no idea what risk management is. He's completely ignoring it. He's going into the stock market almost blindly. He doesn't have a strategy on paper. All right, versus Greg. Greg has a strategy, and he and Alan have the same funds, but he is going to show you why risk management is extremely important when trading. All right, so let's start with Alan. And we can see Alan here. He has a 30K portfolio. All right, and his plan is he's going to go in 10K on every play. All right, he's going to go in 10K on every play. He figures he has to hit one. All right, and sometimes it always doesn't work that way. Greg, on the other hand, is going to go in 1K on every play. He's using correct risk management. He's not putting all his eggs into one basket. So he is he's going to approach this with correct risk management in general. All right, and right here you can see that the 10 trades are at a 50% win rate. They're randomly put, but you have 5 wins and 5 losses. All right, so let's go ahead and see what happens. So Alan went ahead and invested 10K in his first 3 trades. All right, and that basically gave him the negative 30K pretty much right away. All right, so in the next 7 plays, he does not participate because he already blew his entire account, and he's sitting at negative 30K, and at the end he has $0. Okay, so he didn't use any risk management and ended up paying the full price of his account for it. All right, now let's go to Greg. Greg's got the same 30K, but Greg decides to go in 1K per play. All right, he says there's no reason I need to put my whole account into anything, or half of it, or a third of it, or a quarter. I'm just going to put 1K into every play, and we'll go from there. So Greg, unfortunately, loses the first 3 plays, and he takes his 30K down to 27K. All right, so he's minus 3K on the first 3 trades. However, the next 2, he wins. All right, those pay off. And at a 1 to 2 risk reward ratio, you're adding 4K to the 27. So the 27 becomes 31K. All right, now let's say the next 2 trades, right, following the sequence are losses. So he loses 2 more K, which brings him down to 29K. All right. However, per the sequence, and just to even it out at a 50% win rate, these 3 wins bring Greg up 6K from that original 29K position he was in here. 6K, and now he'll be sitting at 35K after the same sequence of trades. He's up 5K, and his total account is at 35K. All right. So in the same series of trades, we saw how Alan went from a 30K portfolio to 0 without using any proper risk management. And then we saw how Greg turned his 30K into 35K, even though he had the same number of wins as he did losses. All right. And you can do that with proper risk management. and we're going to show you exactly how to apply it to options contracts given various different situations and assuming your own personal risk tolerance. All right. So in the first video, we showed you how Alan and Greg use general risk management just to be able to make correct decisions from a large scale, on a 50% win. But now we're going to show you how to apply risk management specifically for each play. All right, so we have 5 examples out here for you, and we're going to go through each of them. All right, all 5 examples involve a trader that has $100K of capital. All right, so he's got $100,000. Okay, and in the second column here, you're going to see that we have risk percentages, all right, based on their risk tolerance. All right, so for the first 3 examples, they're going to be using 1%. And then, we obviously up that to show you how it would reflect. All right, so let's play out through a couple of these. All right, so let's say in example A, you've got $100K of capital. You want to risk no more than 1%. All right. So let's say you're getting an option contract and the cost of the contract is $500, okay? Now, you're going to set a predetermined stop loss. And what that means is if your contract is ever worth this stop loss value right here, it's going to automatically sell to prevent further loss, all right? So your stop loss is set to minus 20%, all right? Which would result in a $400 sale price should the contract go anytime under minus 20%. All right, so in this first example, we're going with stop loss that is minus 20%. All right, and the total you can risk here is $1,000. And the reason for that is because you had the 1% risk percentage. So basically this is just 1% of your capital, and it's going to equate to this $1,000. So 1% of 100,000 is 1,000. All right. Over here, automatically you can tell yourself that you can have, you can buy up to 10 contracts here and risk no more than what you want to risk. In this case, 1%. So the reason that you can get 10 contracts is because if we look at the cost of each contract, all right, and you have your minus 20% stop loss, that means that if you buy 10 contracts, all right, and they cost you $500 each, so it would be $5,000, and they all sold at the $400 per contract, you'd have $4,000 left, which would mean that you lost $1,000, all right, which is no more than the risk that you wanted to play, and it is 1% in that case. All right. So let's look at example 2. All right. You also have 100K and same risk percentage, 1%. The cost of your contract is the same, $500 contract. All right. But what we're going to do here is instead of a minus 20%, we're going to do a minus 10% stop loss. All right. Which means that our contracts will automatically sell should they hit the $450 mark. All right, for minus $50 per contract. And if your risk is the same, if your risk percentage that was given here in example A is the same here, that means that your risk dollar amount is still $1,000. All right. So if you still only want to risk up to 1,000, your max number of contracts that you can buy is 20. And the reason is because if it does hit your stop loss, you will be losing $50 per each contract. And that $50 loss will carry over times your 20 contracts, which is going to be the $1,000 max. Okay, now this is, of course, only assuming that your direction was wrong and the play failed to hit your stop loss. All right. Now, we look at example C, where once again, we have the same 100K capital, same 1% risk score, risk percentage, and the cost of the contract is still $500, except this time, we're going to use an aggressive stop loss, and we're going to say it's 50%, okay? Which means that your contracts will automatically sell at $250, all right, should they reach that low to prevent further loss, all right? Your risk dollar amount is still the same at 1,000, but if you set your stop loss this low, you can only afford to buy 4 contracts before you start risking more than you wanted to, All right, so your risk is 1% out of that 100K. It's $1,000. If you set this stop loss right here, that means each contract will be sold for $250, which, again, you can only buy 4, because if you buy any more than that, you'll risk losing more than the $1,000 you want to lose. All right, 4 times 250, of course, is the $1,000 loss in that scenario. All right, now in example D, right, we see that we also have 100K capital. Our risk percentage now is 5%. All right, so that's pretty high risk tolerance, 5%. All right, now our cost of our contract is, again, $500. We're going to use a minus 20% stop loss here. All right, so that means your contract will automatically sell at $400, or minus 100 for each contract. But your risk dollar amount, because your risk percentage is 5%, your risk dollar amount becomes 5,000, which means that if you use a 20% stop loss, you know, selling at $100 loss of each contract, you can afford to buy 50 contracts and still fall within your 5% risk. Okay, because what will happen is if you buy 50 contracts, all right, you'll be spending $25,000. Okay, you'll be spending $25,000 on contracts, but they will automatically sell at $20,000 if they're ever worth that low. Okay, and if that happens, you will end up losing $5,000. All right, which is 5% of your portfolio, which is a pretty big hit. All right, so in a 100K capital situation, this isn't ideal. All right, you don't want to go in with 5% of your capital on one play. All right, 5% of your risk on one play. Now, this play right here did cost $25,000, but the limit is capped at that $5,000 loss. All right, so you are putting up $25,000 for these contracts. Just in the worst case scenario, they sell for $20K. So we'll look at the last example, example E. Now, if we go ahead and look into example E, all right, we see that we have 100K of capital. This time our risk is 50%, all right? So we're willing to risk $50,000, all right, which is half of the portfolio in this example, all right? We're going to have $500 cost of contract as in the previous examples. We're going to have 20% stop loss as in the previous examples. Now, if you're using a 20% stop loss in this specific case, in order to be able to risk 50K at 20% stop loss, you would have to buy 500 contracts, okay? And your capital in this case is only 100K, so you can't even afford the 500 contracts that you would need to risk 50K. However, you can afford 200 contracts at the 100K, all right? But let's say that for this example, okay, you're able to buy 500 contracts risking $50,000, all right? Using this basic simple math, you will be able to calculate with however much risk percentage and capital that you have and risk percentage that you want to assume with the cost of the contract and your inputted stop loss. It'll tell you exactly the number of contracts that you'll be able to purchase, assuming the same risk. Okay, so in the beginning, again, you're losing $100 here, and you only want to risk $1,000. You can only buy 10 contracts. All right, you're losing $50 per contract here. You want to only risk $1,000. You're able to buy 20 contracts, and so on. And you can use this method every time to make sure that you set the correct risk management per play that you should be following.